Welcome to the deep dive. Today, we're unpacking something our source material calls, well, potentially misunderstood, but maybe incredibly powerful. Indexed Universal Life Insurance, or IUL.
That's right. Yeah, the source really frames it interestingly, not just, another type of life insurance.
Great.
It puts it at this kind of crossroads of financial planning, suggesting it's a path that looks pretty different from your standard savings accounts or even basic term life insurance.
And they jump right in with this big analogy,
Yeah,
the financial Swiss Army knife.
exactly. That's the core idea they push. Not just doing one thing, but having multiple functions packed in. So protection, yes, but also potential savings growth, tax benefits, flexibility, all in one package.
Okay, so our mission here is to really get under the hood, right? Figure out what an IUL actually is.
Yeah, and how it tries to be this multi-tool the source talks about and, get why someone might see it as a, quote, game changer.
All right, let's start with the basics then. At its heart, what is an IUL?
Okay, so fundamentally, you're looking at permanent life insurance. That means it's designed to cover you for your whole life.
Not like term insurance, which just runs out.
Precisely. Term is for a specific period, maybe 20, 30 years. This is meant to be lifelong.
Permanent. Got it. And that Swiss Army knife part that comes from the cash value, I gather.
That's the key component, beyond just the death benefit. There's this cash value account inside the policy, and it's designed to grow over time.
Okay.
And here's the really unique part. The source highlights how it grows. The potential growth is linked to a stock market index. Think like the S&P 500.
Okay, market-linked growth. That sounds like investing. But the source really emphasizes this idea of doing it without the risk of losing money if the market tanks. That seems counterintuitive.
It does, yeah. And that's probably the most talked about feature. How does it work? Well, typically these IUL policies have something called a 0% floor. It's usually contractual.
0% floor, meaning
Meaning, if the market index your policy is tied to goes down in a particular year, say the S&P drops 10%, the cash value that gets credited based on index performance won't decrease because of that market drop.
So market goes up, you potentially get some of that upside credited.
Right.
Market goes down, your cash value just sits tight. It doesn't shrink from the market loss itself.
That's the core concept, yes. The source used the sailing analogy, which I thought was pretty good.
Oh, yeah.
Yeah, like when the market winds are good, your cash value catches some wind, moves forward. But if a storm hits, the market dives. The sail kind of flattens. You don't get pushed backward by those negative returns.
Okay, the sailing analogy helps. Catch the good wind, flatten the sail in the storm.
Yeah.
So you get potential upside participation.
Without the direct downside market risk to
Right.
your principal cash value.
Yeah. The source even uses that phrase, like having your cake and eating it too.
Right, I saw that. But okay, there has to be a catch, right? How can they offer that protection? Well, yeah, there's a trade-off. It's not magic. These policies use complex internal insurance company strategies, often involving financial instruments like options, to provide that floor.
Okay.
But the trade-off usually comes in the form of a cap rate or sometimes a participation rate on the upside.
A cap rate, like a ceiling.
Exactly, like a speed limit on how much of the index's gain you can actually be credited with in a good year. So maybe the S&P 500 shoots up 20%.
Which would be great.
Fantastic. But if your policy has, say, a 10% cap rate for that period, then the index-linked growth credited to your cash value might be limited to that 10%, even though the market did better.
Ah, okay. So you trade potentially huge gains in amazing years for the safety net in the bad years.
That's generally the mechanism, yes. The insurer uses that difference, that spread, to help pay for the downside protection. It's a crucial detail beyond just the simple zero floor idea.
Definitely adds complexity. Okay, let's pivot. How does this stack up against plain old term life insurance? Most people kind of get term life.
Right, term is pretty straightforward. It's pure life insurance protection. You pick a term, 20 years, 30 years.
Pay your premium.
Pay your premium, and if you pass away during that term, your beneficiaries get the death benefit. It's usually much cheaper up front because it's temporary.
The source compared it to renting, didn't it?
It did. Renting a house. You pay rent, you get shelter, lease ends, you move out, you don't own anything, no equity built.
And with term, the term ends, the coverage stops, and the premiums you paid are just gone. The cost of that temporary safety net.
Exactly, whereas IUL, being permanent, is different.
How so?
Well, first, the coverage is designed to last your whole life. And second, crucially, it has that cash value component building up.
The equity part.
Precisely. The source compares IUL to owning a home. You have the protection, the roof over your head, and you're potentially building equity, the cash value that you might be able to tap into later.
Renting versus owning, that makes the difference pretty stark. The source also had that other analogy, checkers versus chess.
Ah, yes. Term life is like checkers. Simple rules, pretty predictable, lower costs to start playing.
Get your kings lined up.
Right. IUL, though, is framed more like chess. More complex, different pieces, the death benefit, the cash value, the index linking, the loans all moving together requires more strategic, long-term thinking.
Speaking of strategy, tax advantages seem to be a massive part of the source's argument for IUL.
Oh, absolutely huge. It highlights a couple of key things. First, like a 401k or traditional IRA, the cash value inside the IUL grows tax deferred.
So no taxes on the gains each year as it grows.
Okay. Correct. But the really big potential advantage the source emphasizes is accessing that money later.
How do you do that?
Typically through policy loans. And here's the kicker. When structured and managed the right way, you can often borrow against your cash value completely tax-free.
Tax-free access. How does that conceptually work? Is it like borrowing from yourself?
Kind of. The source uses a nice analogy here too, planting an apple tree. The tree is your policy's cash value growing over time. The apples are the growth, the returns. With policy loans structured properly, you can effectively pick those apples, access the value without the IRS taking a bite, taxing that distribution.
That's a good picture. Accessing the fruit without chopping down the tax tree or something. The source even called it a Roth on steroids, right?
Yeah, that's a pretty bold comparison they make.
Why on steroids?
Well, a Roth IRA gives you tax-free growth and tax-free withdrawals in retirement, which is great. But there are strict limits on how much you can contribute each year.
Right, the annual contribution cap.
Exactly. With an IUL, while there are insurance costs and funding considerations, you can potentially put in much larger sums over time, building up a potentially much larger pool of cash value that you could then access tax-free via those loans.
Ah, okay. Less restrictive funding, potentially bigger tax-free pool later. How does it compare to, say, a traditional 401k?
Well, 401ks and traditional IRAs also give you that tax-deferred growth.
But you pay income tax when you take the money out in retirement.
Precisely. It's taxed as ordinary income then. And the source makes a point about this. You're kind of at the mercy of whatever tax rates are in effect when you retire, which could be higher than today.
So the IUL's tax-free loan access is presented as a way to potentially hedge against future tax hikes.
That's a key part of the argument. It's framed as creating your own sort of private, potentially tax-free retirement bank. A financial bunker, as the source put it, that might be less vulnerable to future changes in tax laws that affect traditional retirement income streams.
Okay, that bunker idea really hammers home the protection aspect. It fits with that Swiss Army knife theme.
Yeah.
It's not just one thing. The source mentioned protection plus possibility.
Right, and the dual-engine jet analogy they use.
Dual-engine jet.
Yeah, the idea is most financial products focus on one main thing, growth or protection. Like an investment account is mostly about growth. Traditional insurance is mostly about protection.
Okay.
The source argues IUL tries to have two engines running at the same time.
Engine one, the death benefit. Financial safety net for the family.
Correct, that's the protection engine. Engine two, the wealth accumulation potential through that indexed cash value growth.
So lifelong protection plus the potential for the cash value to grow.
Exactly. And the source emphasizes this isn't just about planning for after you're gone. It's also about, quote, enhancing your life while you're still living.
Enhancing your life.
Yeah.
That means using the cash value, the living benefits.
That's it. The source talks about tapping into that accumulated cash value during your lifetime, maybe supplementing retirement income tax-free via loans like we discussed.
Or other things.
Yeah, maybe helping pay for kids' education or having a readily accessible emergency fund if something unexpected comes up.
So the money isn't totally locked away until you die.
Not according to the source's portrayal. It uses the analogy of a financial trampoline.
A trampoline.
Yeah, something there ready to give you a lift if life pushes you down unexpectedly or maybe even provides a launch pad for an opportunity. You can potentially access these funds without the typical age restrictions, like the 59.5 rule for 401k or the penalties for early withdrawal you see in those plans.
That lack of age penalty, that sounds like a lot of flexibility.
It really is positioned that way. When you compare it to, say, a 401k with its contribution limits, eventual required minimum distributions, penalties if you need money before retirement age, the IUL is presented as much more adaptable.
That moves with you.
Kind of like a financial GPS, as the source put it. Need funds at 45 to start a business. Maybe you can access them via a loan without penalty, change jobs. Your IUL policy isn't tied to your employer, it goes with you.
Can you adjust payments too?
Often, yes, within certain limits set by the policy contract. You might have some flexibility to increase or decrease premium payments over time, depending on your situation and the policy's performance. It's designed ideally not to feel like a trap, but a tool that travels with you.
Okay, let's shift gears slightly to the legacy part. The source called IUL a silent wealth multiplier. What's that about?
This ties the permanent death benefit and the cash value access together for estate planning. The source painted a scenario.
Yeah.
Imagine someone uses their cash value quite a bit during retirement. Maybe they take out, say, $200,000 over the years through those tax-free policy loans.
Okay, using the living benefits.
Right. But because it's permanent insurance, when they eventually pass away, there's still potentially a much larger death benefit left, maybe $500,000 in the example, depending on the policy specifics and how it was managed. And that death benefit generally goes to their beneficiary's income tax-free.
Wow, so you can potentially use a good chunk of the value while living.
And still leave a substantial tax-free inheritance behind.
That does sound like multiplying wealth silently.
That's the idea presented, a wealth transfer tool. The source uses analogies like financial time machine, enjoy some wealth now, secure more for later, and even ninja of generational wealth.
Ninja. Why ninja?
Because, unlike assets that might get tied up in probate court or potentially face estate taxes, the IUL death benefit usually passes directly and privately to the named beneficiaries. Quick, efficient, and tax-free. Stealthy, like a ninja.
Okay, we've covered a lot of the positive features the source highlights. It sounds incredibly versatile, but, no financial product is perfect. What are some of the counterpoints or complexities the source maybe doesn't emphasize as much or that critics often bring up? We need that for a real deep dive.
Absolutely a critical point. While the source focuses heavily on the potential upsides, IULs are complex insurance products, and they come with internal costs.
Costs? Like what?
Well, there's the basic cost of the life insurance itself, which typically increases as you get older. There are administrative fees, premium load charges, sometimes surrender charges if you cash out early. These costs are deducted from your premiums or your cash value.
So the cash value growth isn't just pure market-linked gain. It's that gain minus these internal costs.
Exactly, and that's really important. The illustrations you often see when considering an IUL show hypothetical future growth based on certain assumptions, assumed index returns, current cap rates, current costs.
But those are just projections, right? Not guarantees.
Precisely. Actual performance can and likely will vary. If the index doesn't perform as well as illustrated, or if internal costs end up being higher than projected, or if you don't pay enough premium, the cash value might not grow as expected.
And that could cause problems.
It could. In the worst case scenario, especially in later years when the insurance costs are higher, if the cash value growth can't keep pace, the policy could potentially underperform significantly or even lapse if not enough premium is paid to sustain it.
Lapsing sounds bad. And what about those tax-free loans? Any catches there?
Yes, they need careful management. Policy loans aren't free money, they accrue interest. Usually it's a variable rate. While you're borrowing against your own value, that accruing interest adds to the loan balance.
So the debt grows.
Right. And if the loan balance, including that accrued interest, eventually gets too big relative to the policy's remaining cash value, it could cause the policy to lapse. And if a policy lapses with a large outstanding loan, that could potentially trigger a significant taxable event. Basically, the amount of the loan that exceeds your cost basis, the premiums you paid in, could suddenly become taxable income.
Ouch. Okay, so tax-free access comes with a big asterisk, if managed properly.
A very big asterisk. It underscores the complexity and the need for ongoing monitoring and understanding. It's definitely not a set-it-and-forget-it type of product.
That complexity and need for management really adds context to the source's potential benefits.
It does, and it explains why, as the source implies, it's not the right fit for everyone.
So, pulling together what the source did say and the context we've added, who does the source seem to suggest is the ideal candidate for considering an IUL?
Well, the source generally points towards people who've already kind of checked the boxes on their standard retirement accounts.
Like maxed out their 401k or IRA contributions.
Exactly. They're looking for additional places to save and grow money with tax advantages. So it's often positioned as a supplemental tool, not a primary one for most people.
Okay, using the traditional stuff first. Makes sense. Who else?
Also, individuals who really like the idea of market-linked growth potential, but are also quite concerned about avoiding market losses. That 0% floor feature is a major draw for this group.
The sort of risk-averse growth seeker we mentioned.
That profile, yes. And crucially, people who genuinely want or need permanent life insurance coverage anyway.
Right. The death benefit aspect is still core.
And they value the idea of having flexible access to their cash value during their lifetime for those various needs we talked about. The living benefits are key.
So wanting both protection and flexible access.
And finally, the source suggests it's for people who are really thinking long-term, strategically. Someone committed to a financial plan over decades who understands this is a complex instrument designed for the long haul, not some kind of get-rich-quick scheme.
Got it. Strategic, long-term thinker needing permanent insurance, wanting market linking with downside protection, and flexible access after maxing other accounts. That's a specific profile.
It is. It narrows the field considerably compared to just general financial advice.
Okay, let's wrap this up. The source concludes with this really strong metaphor, comparing financial plans.
Yeah, the sandcastles versus fortresses idea.
Tell us about that.
The source suggests as many people build their financial plans kind of like sandcastles on the beach, vulnerable.
Vulnerable to what?
To waves, right. Waves of market crashes, unexpected job losses, rising taxes, healthcare costs. Things that can wash away fragile plans.
Okay, so sandcastles are bad.
Relatively speaking, yes. The alternative presented is striving to build a financial fortress, something more resilient, more robust, built to withstand those storms.
And the IUL in this metaphor is like a key part of building that fortress.
Exactly. It's positioned as a potential cornerstone because it brings together multiple elements: that potential growth, the downside protection, the tax advantages, the lifelong insurance, the flexibility, all intended to create a stronger overall financial structure.
More than just insurance, it's a living, breathing asset, as they put it.
That's the framing. It tries to embody all those different roles we discussed.
The Swiss Army knife, the chessboard, the dual-engine jet, the trampoline, the ninja.
All rolled into one component aimed at building that long-term financial fortress. It really tries to tie all those analogies together into one big picture of security and potential.
So to quickly recap our deep dive, indexed universal life insurance. The source material paints it as this really versatile, multifunctional financial tool.
Right. Combining permanent life insurance protection with cash value growth potential that's linked to a market index, but importantly, with that 0% floor to protect against market losses, though usually capped on the upside.
Plus those potentially powerful tax advantages, especially accessing cash value tax-free via loans if managed right.
And significant flexibility for using that cash value during your lifetime, maybe even passing on a tax-free legacy.
But we also noted the complexity, the internal costs, the reliance on non-guaranteed projections, the critical need for proper management, especially with policy loans.
Absolutely. The source's core message seems to be, it's not simple, it's not for everyone, but for certain people, those looking for that specific blend of long-term protection, growth potential with downside buffering, tax advantages, and flexibility, particularly after exhausting other options, it could be a powerful strategy.
Which leaves us with a final thought for you, the listener. If much of conventional financial advice revolves around choosing distinct single-purpose tools, this for insurance, this for saving, this for investing, how might really understanding a complex multifunctional instrument like IUL, with all its potential and its pitfalls, how might that change the way you approach building your own long-term financial fortress, thinking beyond just the standard separation of financial tools?
It definitely makes you question the neat little boxes we sometimes put things in, doesn't it?
Something to think about as you weigh your own financial strategy